Friday, November 29th, 2024, Maneco 64, home of alternative economics and contrarian views. Good morning, Clive. How are you doing?
Hello, good morning to you, Mario. Looks like a nice day at your end, and it looks like a nice day at our end too.
Yes, it was nice yesterday, but very cold. Today's a little not as cold. Anyway, Clive, it's good to have you back. And yesterday, of course, I didn't do like my usual video. It was Thanksgiving in the US, and I guess it's still, Americans are still celebrating Thanksgiving today. The markets will reopen. But what we want to talk about today is the US Treasury or the debt situation. And I'm wondering, Clive, and I'm not trying to be a negative, but a realist, whether there's a kind of a debt time bomb that could be detonated in the next year or so, and mainly because of mathematics. We have a lot of debt to be issued by the U.S. Treasury, debt to be rolled over, and the current administration under Yellen's leadership has been aggressive in issuing short-term debt, which has made it really, yeah, it switched things around. For example, there's this Bloomberg article here that I'll share, and it shows just how much more debt they're going to have to issue next year because of what Yellen did. Some people criticized her and said that she was doing that in order to take the pressure off the longer end in order to goose the economy up. But now it's backfired because short-term rates are actually going up, despite the fact that the Fed has cut rates. She, of course, has denied it. But one thing that I think is really interesting here, Clive, is this here in this article. And this article is, of course, behind a paywall. It says Besant has 6.7 trillion mountain of worry waiting at Treasury. But anyway, this is what I found interesting here. It says the share of Treasury market owned by what are considered price insensitive buyers, such as the Federal Reserve and foreign central banks and governments, has dropped to around 50%, the lowest since 1997, according to the rate strategists at JP Morgan Chase and Co. Their share was about 75% as recently as 2015. This means that more treasuries are in the hands of investors, such as hedge funds, that are more willing to sell in response to changing market conditions, potentially creating volatility and causing yields to remain higher than otherwise. Interesting, Clive, that they mentioned here 2015, and the Treasury and the Fed have been trying to figure out why there's less liquidity in the Treasury market. It's been a problem, and they actually mentioned 2015. I don't know if you're familiar with that, and it's easy to know why there's less liquidity and the market is thinner. Well, it's because the big institutional buyers, the central banks, are absent. And then there's this here, Clive, as well, that I think from a Yahoo Finance article, 5 key charts to the new Treasury Secretary to watch. Here, Besant has said he would like to reduce the deficit as share of gross domestic product to 3%. For fiscal 2024, which ended September 30, it was 7.8% of GDP. And that's adjusted real GDP because sometimes they come out with a nominal number, and I think that was like six point something. And it says GDP has not been this deficit to GDP has not been at 3% or below since the Obama administration. And under Trump, it was quite high as well. And CBO, this who you like to follow a lot, Clive, they said their baseline forecast is 6.1 next year, to 5.6 before Trump leaves office. And we know that their forecasts sometimes are too conservative, and that
I mean,
this.
I think it's fair to say they consistently paint an over-optimistic picture of the debt to GDP ratio and other ratios. I mean, everything. They base their numbers on the official budget, but inevitably, when you have something official, you have unforeseen expenses, and things are always worse than they project.
So, Clive, after listening to me here about what's going on in the treasury market and with deficits, and before you go on to another article that you found that's really interesting, could you tell the viewers why this is so important and how it could affect interest rates or bond yields and how that would affect the economy going forward?
So, for your viewers who are interested, I wrote an article on LinkedIn about a week ago called The Debt Bomb. And it refers to both the UK and the USA, which were two countries I studied for that article. And I took the official numbers from, in the UK's case, from the Office of Budget Responsibility, and in the USA's case, from the Congressional Budget Office. In both cases, they are projecting that the level of debt compared with GDP in the next few decades is going to rise to several 100%, around 300% if we stretch it out to the time my children are in their 30s. My child is quite young at the moment, but so any child being born today is going to be facing a level of debt which is at least 2 times as much as it is today in real terms. That's in real terms. In other words, it will have grown much faster than the economy. Now, that's obviously a problem because when you have debt, you have to pay interest on it. And the environment we're in at the moment is an environment where interest rates are a lot higher than they've been over the last 15 years. They raised interest rates a couple of years ago to about 5.5% in the USA and obviously the rest of the world as well. And now they're coming down slightly, but they're still way above where they were 5 years ago or 3 years ago, for that matter. So what that means is there's an awful lot of debt maturing, which has to be renewed because they can't repay it, has to be renewed at a higher rate. Now, I seen an article a couple of days ago, maybe yesterday I saw it, from a company called Apollo Academy, which I think is an investment management firm. They've done a study, and it says that the US government will have to renew $7.6 trillion of treasury loans in the next 12 months. That's about 31%, they say, of the total debt of the United States. So all of that debt is going to be renewed at an interest rate which is much higher than the amounts which are maturing. So the amounts maturing were probably incurring an interest rate of 1.5%, 2.5%, something like that, because those debts were taken out during the global financial crisis and the decade which followed, therefore at very low interest rates, when effectively short-term rates were zero. But the new rate, if we look at the 10-year yield, is about 4.4%. And so that's going to be, all of that debt is going to be renewed at a rate of interest which is double what the maturing debt is. And on top of that, we've got perhaps as much as 2 trillion of budget deficit to be funded. That's the biggest in all of history. And maybe on top of that, we've got a continuation of the central bank, the Federal Reserve's quantitative tightening program. Now, I have no idea if they're going to continue with their quantitative tightening. That's where the Federal Reserve shrinks their balance sheet by selling off treasuries. They may have come to the end of that. They haven't said they've come to the end of it. But what all this means is that over the next year or so, whether the Treasury sells their existing Treasury holdings or not, we are going to see dumped into the market, or a demand from the government to borrow a record amount of money which means that the public at large are going to get indigestion. And we talked about the willingness of the number of people which have, or number of institutions which are indifferent to interest rates. Now we're talking about more and more hedge funds and private investors and so on who are sensitive to interest rates. They're going to be expecting a higher interest rate before they'll buy those bonds. So I think Janet Yellen, yes, by borrowing at the short end, it was very beneficial prior to the election because it kept interest rates from spiraling out of control. But of course, it's going to cause a bit of a problem now because all that short-term debt is maturing over the next 12 months and will have to be refreshed. So I think we're in for a period of higher interest rates. We're seeing that in effect because we've seen, although the short-term interest rate from the federal funds rate has been reduced by 0.75% so far. We've seen the interest rate on 10-year bonds rise by 0.75% in the same period. And I think there's more of that to come. So I think we're probably going to see higher interest rates on government bonds. And the question is, at what point does that become a problem? And the other problem, of course, is as we step forward through the years, the interest that the government is paying is becoming a larger and larger percentage of the tax take. And at some point, it will be some decades out if it can continue. I don't think it can continue, but if it does continue, some decades out, the interest on that debt will be exceeding the totality of all their taxes. So it's a bit like saying the interest on my credit card debt is exceeding the totality of what I earn. It's clearly getting to a point where it would be unsustainable. Of course, something has to happen before we get there. We won't get to that point. I don't know what will happen. It could be high inflation. We'll have to see. But it's definitely a problem looming. And everybody in the know, including Janet Yellen, Jerome Powell, and every president we've ever had in America has basically said that. It can't continue. It's unsustainable.
Yeah, and I'm sure a lot of people are going to say it doesn't matter. It's been going and going, but I'm not too sure. And Clive, the other thing that from that Bloomberg article is that the maturity of the U.S. debt, as you can see here, is almost 6 years. So what that means, in my opinion, and you look at the 2020, 2021, that was when we had the COVID crisis, whatever you want to call it. Interest rates, let's say on the 10-year, went down to zero point 0.3 basis points for a very short period of time, of course. But rates were really low back then. And if the average maturity is almost 6 years, it means that 2025 and 2026, that's going to be like converging with this 7 trillion plus a lot of the debt that was financed like at less than 1 or 2%. It could be quite explosive. And
Yeah, maybe I was too generous, perhaps, to the government when I said the rates moved from 1 to 2% to 4+4. Maybe it's going from less than that to over 4.
yeah, yeah. And the other thing, Clive, with the budget deficit is that in times of like normal growth, which is what we're supposed to be having now, and not a recession, that debt to GDP should be around 3%. Or in ideal world, maybe it should be balanced, the budget, but I'm not waiting for that. It looks like Besant actually thinks that 3% deficit to GDP is okay. But let's say that there's a recession that pops up in the next 6 months. I mean, that would make it really hard for the Treasury and the Fed to bring in this Keynesian strategy of automatic stabilizers. What do you think?
Well, historically, we have our crises which come along from time to time, whether it be wars, recessions, pandemics, banking crises, or some other crisis. They are few and far between, but inevitably, sooner or later, there will be one. And when they do their budgets, whether it be in the UK or the USA, they assume that none of these crises will ever happen. But the reality is, we will get a crisis. We don't know what it will be or when it's coming. And when that crisis occurs, it throws out their figures. And that means that the deficit, because when you have a crisis, you have to spend money on it. It means the deficit widens. That's the budget deficits where they're spending more money than they're collecting in taxes. So already we're in a situation, apart from the COVID year, where governments are spending more money than they're collecting in taxes by a record amount. But and that's in a year when the economy seems to be doing just fine. So what happens when we have one of these crises? Well, it gets a lot worse and the debt grows much faster. And of course, the other corollary for that is the interest on the debt is going to grow much faster.
Yeah. Did you hear that Scott Bessent, and I listened to an interview he did, a podcast, and he said he's long gold, and that's his biggest position. He said we're in a long-term bull market. The other thing he said he admired Prime Minister Abe and Abenomics. So what is Abenomics for those who don't know? Well, it's a policy of keeping the currency weak, of keeping interest rates low. And how do they do that? Well, by a lot of deficit spending, a lot of yield curve control, which means the Fed will have to print money or say that they won't let yields go above a certain level. It all seems really interesting, and it makes you wonder whether Jay Powell will listen to Scott Bessent, because recently someone asked him, what if the new Trump administration wanted to sack you? And he said, they can't. He was very clear. So what's,
I wonder if Jay Powell is long gold. It's interesting to hear best. I mean, these are very powerful people who are making the wise decision to go long gold. And I'm wondering how many other people in the U.S. administration are long gold. If you listen to their words about the unsustainability of the debt, the obvious thing they should be doing behind the scenes, assuming they're allowed to, would be to buy gold. But whether they're actually doing it, we don't really hear that. By the way, Mary, I just wanted to show you my latest gold purchases.
oh
Now,
yeah, wow,
that's it. Now, as everybody knows, this is Swiss money,
yeah.
and the beauty of Swiss money is we make it in chocolate. So this
Oh,
is
oh, okay. I was. Oh, that's the chocolate money. Okay, I thought you loading up and talking about loading up on gold, Clive. I
uh, well,
thought
I mean, the beauty of Swiss money is we don't have any increase in the money supply because we eat it.
yeah, that's good. Well, talking about like I thought, wow, Clive is buying more gold than the Czech Republic. So this is a topic I wanted to cover as well, Clive. So, Gold Telegraph on X, and I recommend people follow Gold Telegraph there if you're on X or Twitter. He says the Czech Republic central bank aims to double its gold reserves to 100 metric tons within 3 years. And I guess the head of the bank said, we need to reduce volatility. We need an asset with zero correlation to stocks, and that asset is gold. Gold is the foundation of the monetary system. Well, that's Gold Telegraph. I agree with him. And it's interesting,
Well,
Clive, just one more point here, that Scott Bessent also said he was surprised that Poland has been buying a lot of gold, and they've been the biggest buyer as well of gold this year.
well, it's good to hear these people have got their brains in gear. That Czech Republic central bank governor, I think he deserves a pay rise because he's going to save the country from lots of financial problems by holding if he was because they won't be holding so many treasuries.
Yeah, and it's weird because in Western Europe, we don't hear our central bankers. Maybe the Dutch central bank is a little bit more gold friendly. They made some comments last year similar to these, but you don't hear that from Andrew Bailey or Jay Powell or what's her name, Christine Lagarde. Anyway, going along with this, Eric Jung, who I interviewed recently, he's based in Hong Kong. Really interesting character. He says Trump loves gold, Scott Bessent loves gold, Judy Shelton loves gold, and they all own a lot of gold. Says the world's biggest buyers of gold are now among East European central banks. So it's not just the Czech Republic, but the Poles, the Serbs, Hungarians, and it's yeah, it all seems to be related to the fact that they've been through the socialism and the collapse, and they know maybe what's coming. Clive, is that what you think?
I think so. I think they are saying why, just like many governments said back in the 1960s, when they tried to turn their dollars into gold from the USA, they said there's a lot more dollars out there, and the amount of gold is not increasing. So the dollar supply is increasing very fast, and the gold supply is increasing very slowly. Let's get the gold. It just makes sense, and I think that's what's happening there. They're saying, if you're going to hold something, let's hold something where we know what the supply is and what it's going to be, not something where you have no idea how fast it's going to increase, which would be the dollars. So that's the move, and it's a very sensible move. Throughout all of history, gold has been the monetary asset, and that's because it's not controlled by. I mean, I know people will argue that it is controlled, but it's not really controlled by any central bank or any government around the world. It comes out of one hole in the ground, passes through a few hands, and then moves back into another hole in the ground. But the supply is only increasing by something like 1% a year. And the number of people on the planet, the population is growing quite fast. The money supply is growing very fast. And so the amount of money out there to buy that gold is increasing all the time. And of course, it makes sense for central banks, which can print their own currency, to load up on gold with paper which cost them nothing. I mean, who wouldn't do that? If you could print money, wouldn't you go out and buy some gold, Mario?
Yeah, yeah.
So,
Especially if I could get people to support me through taxation. If I could knocking at people's doors and saying you owe me this much. And the other thing, Clive, what was I thinking of about gold? Oh yeah, some people will argue that gold is not an investment, and I agree because gold is money. But in an environment like we're in, where the reserve currency is a fiat currency, where the fiscal situation of the reserve currency, i.e., the US debt, and all that we spoke about earlier today, gold becomes like an investment because it will protect you and go up 30% like it has this year. Is that how you see it as well?
I think the gold price will rise fairly fast over the next few years. And the reason for that is it's got a lot of catch up to play with the amount of debt. The US government debt has risen much, much faster and much higher than the gold. So if it was just to play catch up, I think that would be the figure I worked out a few weeks ago was 5,700 for the gold price. But the other thing on the gold price is we seem to have gone in some phases from 2000 to 2011 or 2010 thereabouts, where gold massively outperformed the stock market. In that, Mario, are you still there? I don't know if you've vanished.
I'm still here, Clive.
Yeah, I just saw I lost your
I
picture.
just went to lower the curtain because
Okay, so we saw a massive increase in the gold price from 2000 to 2011 or thereabouts, at a time when the stock markets actually went down about 13%. And then we saw the stock markets rise by several 100%, and the gold price did nothing for a decade. And now it looks like we're at the start of another period, maybe starting 6 months or a year ago, when gold is starting to rise again, and it looks like it's rising faster than the stock market at the moment. So, I think that we're going into this phase, a new phase, where gold is an asset which will be held. Um, I know not every bank is putting it into their asset allocation at the moment, and those which are, some of them are very, very low levels of 1 or 2 or 3%. But I think as the gold price starts to rise, it will find its way into more and more investor portfolios. I mean, we're not really seeing, if you look at the ETFs, we're not really seeing much money flow into gold ETFs yet. And I think that's an indication of the appetite for gold. It's still quite low, but it clearly is growing. And that's the starting point for that has been the central bank buying.
Yeah, and yeah, even I saw a tweet. I don't know if it's true, but even the president of El Salvador, who's been pro Bitcoin, he said wants to reopen the country to gold mining because he thinks having gold is a good thing too. So, I mean, Bitcoin has done well, and I'm not going to say, yes, I don't want to slag Bitcoin or anything, and I don't cover Bitcoin because I cover gold and silver. But notice how the Central Bank of Czech Republic didn't say we're going to buy Bitcoin because it's stable, because it
Mhm.
isn't. Because if you get, in my opinion, a correction in the Nasdaq in the Magnificent Seven, you could see Bitcoin correct as well. So I think it's a little bit more correlated to the stock market than gold. And Clive, maybe we could talk a little bit about our other favorite precious metals that's been a bit forgotten right now, and that's silver. And I'm going to share this article here that I saw. I'm going to put it below in the description if you want to read it. Just thought it was interesting. It's from the Jerusalem Post, November 18th, so almost 2 weeks ago. It says China's silver imports surged to 9,000 metric tons per year, catching up quickly to India. China's silver shopping spree transformed global markets. 9,000 tons imported annually. Strategic resource grab signals tech dominance and economic power play reshaping global commodity landscape. So, what do you think?
One of the biggest uses of silver is electronics. And where do most electronics seem to come from? It's China, and of course they're pretty big in photovoltaic panels, which use a lot of silver, relatively speaking. So we've been seeing over recent years, according to the Silver Institute, fairly rapid rises in the consumption of silver for photovoltaic use and around 20% a year increase in demand for electronics use in general, which includes the photovoltaic sector. I don't think we're going to have less electronic devices next year or the year after than we have today. I think we're going to have more. And basically, they're going to be making more. And if they make more, that means the demand for silver will increase. And the reason silver is used in electronics. It's used in microelectronics, like very, very tiny quantities in microchips, is because of its ability to conduct electricity better than copper. So they wouldn't put copper in crucial parts of devices because copper over time can deteriorate, it can rust away, whereas silver is going to continue to send those electrical signals as perfectly as possible. So that's why they use it, and they haven't yet found any cheaper substitute for silver. So, in my view, we're going to have an ongoing increase in demand for silver. And as we all know, the mined production for silver has not increased over the last decade. In fact, it's gone down, the production from mines. Yet the demand for silver due to electronics is rising rapidly. So I think that's going to continue. And inevitably over time, that will mean that the shortage which we see in silver at the moment, the gap is going to get wider, and that will need a higher price to suck out the silver coins, the silver candlesticks, and those sort of things for recycling.
Yes, I wonder how much longer the bullion banks can keep creating paper supply because what China and India really want, and us stackers, is real physical silver. And I've always told people for years that you need to buy physical silver. I got a comment from someone who follows the channel. Oh, the Royal Mint is offering digi silver and they don't charge VAT. And I said, well, the reason why they don't charge VAT is because it's not real. They don't have it.
You can't have it, yes.
Yeah.
We'll sell you something you can't have, and we
Yeah.
won't charge you VAT. Well, that's a bonus.
Yeah. So, yeah, don't be fooled by the Royal Mint. You can't really trust them. It's a part of the government. and they don't want people buying physical silver. So they say, oh, you can buy digi-silver and you don't have to pay VAT. Oh, but you do have to pay capital gains tax, Clive. I'd rather pay the VAT and not the capital gains tax because I think silver eventually is going to explode because it's probably one of the most hated assets right now, especially with what's happened with cryptocurrency. Clive, before we wrap up, I just wanted to share here where the markets are this morning because that's what I usually do in my normal videos. So we can.
We should also, important, Mario, look at the French
Oh, the
five-year yield.
yeah,
It's
okay.
I can share a screen on that if you like.
I can get it. It's all right. Hold on.
Okay.
Uh,
So while you're getting that, I'll just speak. The yield on the French five-year government bond is
yeah.
now higher than the yield on the five-year Greek bond. Now that basically means that people think it's more likely that France will default than Greece. Just to paint a picture of that, Greece has defaulted twice this century since 2020. Obviously, once was in the global financial crisis of I think 2008 and then 2011 or thereabouts, and then I think it was again in 2015. So Greece has defaulted twice. It's not paid the money that it owes on its bonds, and unfortunately, I was a bondholder on one of those, so I lost out. Now, France is perceived by the marketplace as being more risky over a five-year period than Greece,
Yeah.
and according to the credit default swaps, the probability of default of France is now calculated at 0.53%. That may not seem very high; it's a 1 in 200 chance,
Yeah.
but it's rising.
But
And French bonds yield a lot more now than German bonds, which is
yeah.
the first time. It's the highest difference ever in history, or at least since the euro existed.
Well, the French 5-year OAT, as they call it, obligation, something du trésor.
Assimilé trésorerie,
Yeah.
something like that.
So the 5-year is 2.55, which is actually lower than US Treasuries and gilts, which is strange. And here's the Greek 5-year.
2.39 probably.
Yeah, and people looks like it's down today, five
2.33.
basis points. So I think the hedge funds maybe are buying Greek 5-year and selling the French. Who knows?
So this is the first time in history that a country which has defaulted twice has a lower yield than France. And
Yeah,
France has got a lot of political problems at the moment. They've got a budget deficit problem. Their debt to GDP is at a record level. It's 109.9% of GDP, a bit like the United States actually. And they're running a budget deficit which is I think it's 6 or 7% of GDP at the moment. So
yeah.
it's in trouble.
Yeah, well, and so are we in the UK. I saw the FT reported on the French story. Maybe they're trying to like distract people from what Rachel Reeves is doing here. But I agree with you. It looks interesting, but their rates are still really low. But we'll have to see. And this morning, Clive, as you can see here, gold is up $22, 26.60 almost. The high's been 26,666, which is an interesting number.
That's all the French rushing down to buy the Napoleon,
Yeah,
the gold Napoleons.
and we've got silver up, outperforming gold a little bit, but it's still only at 30.66. And the Dow future, Nasdaq futures, they're all pretty steady. But one thing I wanted to talk to you about a little bit more is the this chart of the dollar yen. Let me just
The yen is strengthening again, isn't it?
Yeah, so the dollar here, for example, is down 1% versus the yen. It's at 150. It got down to 149.52. So I'll bring that chart back up because the more the yen strengthens, the less liquidity I think there is for the whole world's financial markets because it means that the carry trade is becomes more less profitable. And that's what happened around here earlier this year. It was August. Do you remember that? That was a huge drop in the dollar, and then it rebounded, dropped again, And recently, we almost went back up to 160, but it seems to be failing now. This is the yen strengthening and the dollar weakening. So this could also be telling us that the euphoria we've had since the election result, people buying dollars, buying U.S. stocks, could be kind of almost ending the euphoria, and we could see the dollar
Yep.
turn as well.
Well, also the interest rates on Japanese government bonds have now climbed above 1%. And I think that's making the carry trade look less attractive, which means that investors they're probably selling their treasuries to unwind the carry trade, which effectively means they are having to buy back Japanese yen, and that's probably why we're having a rally in the Japanese yen at the moment,
Yeah.
caused by the narrowing gap between U.S. yields and Japanese yields that
And
makes the carry trade less attractive.
I think the other thing that's happening is that the BOJ they've been saying that they're going to continue to tighten, even though slowly. They're still doing QE, and I think maybe the market smells a bad non-farm payroll number next week, and which might push the Fed to cut rates again. I think it's December 17th, 18th, the meeting. And so that's putting a little bit of pressure on the dollar. So I think it will be important to watch that number. It's in a week's time on Friday. So, Clive, have you got, as we wrap up here, have you got any final words or something you're seeing that looks interesting for you that the viewers might not be aware of?
I'm getting a lot of questions about copper. I haven't studied it in detail, but it does seem that uh, there are constraints on the supply, particularly from a company called BHP, which is one of the world's largest copper suppliers, where they're finding that their grades are falling and the rock to get the copper out is getting harder, which makes it much more expensive. But another company which people might want to look at in terms of copper mining is Anglo American. And for those who don't know, BHP has been banned for the last 6 months from making any bid for Anglo American. They did make a bid 6 months ago and they dropped it. That 6 month ban or prohibition on bidding for Anglo American expires today. So maybe one of those two, if you want to get into some exposure to copper, one of those two might be an interesting way to do it. It's not an investment recommendation. I'm just telling you, if you need to be in copper miners, those are two companies which do it.
Yeah, and there are also some gold miners who produce copper and vice versa. And yeah, so Clive, do you want to tell the viewers where they can find you if they're new to the channel so they can communicate with you?
Anybody who's got any questions is welcome to send me their questions on LinkedIn. I only communicate via LinkedIn. I don't deviate to email or WhatsApp or anything like that. But sensible questions about investments or strategies that you've got, I'll be very happy to try and answer your questions. It doesn't matter whether you've got money to invest or whether you're already invested and you want to know if you're doing the right thing. I'll try and give you some guidance. I won't give you investment advice as such, but I'll try and help you see the way whether you're doing the right thing or planning to do the right thing.
Great. Thank you, Clive, and thanks to all of you for your interest in the channel. And I wish you all a very nice weekend. Take care. Bye.
Bye.